Hi, this is Bryan Rich from Money Markets TV. The dollar has been trending persistently lower in recent months. Many experts claim it's the beginning of the end of the dollar's status as the world's reserve currency. Others say it heralds the demise of America as we know it. These viewpoints tend to spread quickly to Main Street, and that has a tendency to create panic. But how bad is it really? For some broader perspective, the dollar index, which measures the greenback against a basket of other currencies, is still roughly 3.5% above its 2008 lows. And the dollar still commands nearly 62% of global currency reserves, down only 3 percentage points since the start of the global financial crisis. So it's not an all-out bloodletting as some of the media would have you believe. In fact, from a fundamental and technical perspective, the dollar actually shows signs that it may snap back violently here. But the panic scenarios still hold sway in the media, and last week journalists demanded answers about the dollar's decline from Treasury Secretary Tim Geithner and Federal Reserve Chairman Ben Bernanke. Geithner's comment was unusually defensive. He said that as long as he's around, the U.S. has a strong dollar policy. Bernanke maintained his usual stance, saying that a strong and stable dollar is important to the U.S. and the global economy. So if policymakers favor a stronger dollar, why aren't they showing concern about its slide? Some suggest they just don't get it. Others insist there's some sort of covert operation by U.S. officials to devalue the dollar. That theory doesn't make a lot of sense, because a protracted decline of the dollar, especially at the pace of recent months, would have very negative implications for both the U.S. and the rest of the world. However, I do think U.S. policies like a weaker dollar in the near term. It helps stimulate exports and manufacturing growth, all important factors in an economic recovery. In fact, exports have become a big driver of economic growth throughout this recovery phase. The Wall Street Journal reports that exports have made the biggest 18-month contribution to U.S. GDP growth on record. But on the downside, the weaker dollar is exacerbating the inflation in commodity prices. Even more troubling is the risk of capital flight, which could pose a serious threat to a country's solvency. But in reality, that's just not happening. The truth is, growth in the U.S. continues to be near the top of major developed economies. Meanwhile, inflation and market interest rates remain relatively low and more stable than their counterparts, providing a solid underpinning for a stronger currency going forward. Given the continued problems in Europe and the Middle East and North Africa, and the reality that the world is in a slow, bumpy recovery, I think the recent slide in the dollar is more consistent with the normal ebb and flow that we typically see in currency markets. However, the rise in commodity prices and a weaker dollar are hurting one nation, China. They've been trying unsuccessfully to get a grip on inflation. But rising global asset prices, inflamed by a weaker dollar, puts pressure on China to finally adjust its currency policy. 6 years of gentle prodding by other nations hasn't done the trick. The yuan is appreciated by an average of just 3.6 percentage points against the dollar since they depegged the currency in 2005. Meanwhile, China's economy has expanded by nearly 250% in the same time frame. That's allowed China to maintain a massive unfair advantage in global trade. But with a weaker dollar now driving up the cost of Chinese exports and input costs, the country may finally look to its currency policy to curtail inflation. Now, that would be a dollar devaluation that the entire world would embrace, and would go a long way toward putting the global economy on a path of sustainable recovery and correcting these continued booms and busts taking place in global economies and in financial markets. I'm Bryan Rich from Money Markets TV. Thanks for watching.